Hey guys, so there's been a lot of new events that have happened this past week that you should be aware of, both the bullish and bearish events. This news affects Solana, Curve Finance, crypto privacy, and all money markets. It's been a packed few days in the wild west of Web3, not the least of which is how to fake an entire DeFi ecosystem. So make sure you liquidate that like and subscribe button, and let's get right into it. So there's been multiple hacks over the last week. You had Solana hot wallets. Over 8,000 hot wallets were compromised in an exploit that resulted in over $4.5 million worth of tokens being stolen. And the most recent one is Curve Finance that just had an exploit. Curve Finance is a really popular major DeFi protocol, and recently over 530,000 was stolen yesterday after a hacker was able to take control of the name server to reroute the DNS to a malicious server. The front end of the Curve website was cloned to trick users into believing they were interacting with a legitimate site. The front end exploit of Curve Finance has now been resolved, but not all DNS records have yet been propagated, so caution is advised. I've put a link in the description below on how to check if you're safe from the Curve exploit. So just a couple days after over 8,000 Solana hot wallets suffered a $4.5 million hack, Solana is seeing yet another troubling event come to light. And I kid you not, this headline shocked me as well, because this time it involves two guys pretending to be multiple people to misleadingly inflate the Solana DeFi TVL. Now, DeFi is decentralized finance, and TVL is short for total value locked. During DeFi summer, a lot of people use TVL as a barometer of success. But over time, it's now become more of a vanity metric than anything else. And this story is just another reminder why. So this is the story of the McMahon Brothers. They were two 20-something-year-old computer programmers based out of Texas that used anonymous online accounts to fake an entire DeFi ecosystem on Solana. This is crazy because 11 different profiles were used by the same person, Ian McMahon, and both brothers were behind Saber, Sunny, and Casio protocols, which at its peak operations contributed a staggering $7.5 billion to Solana's TVL. Ian revealed in this unpublished blog post that I devised a scheme to maximize Solana's TVL. I would build protocols that stack on top of each other so that a dollar could be counted several times. He wrote, I believe it contributed to the dramatic rise of Sol, the native token of Solana, and I am revealing this because it is inevitable that I will be found out. So Ian explains that his motivation was that he believed Ethereum's DeFi ecosystem was all double counted with stacked protocols, and that he wanted to do something similar for Solana. Now this, I think, is the guy, and he doesn't even look like he can buy a beer yet. But according to him, his scheme was merely to boost the viability of Solana and not for personal gain, despite investors losing thousands of dollars when things started to fall apart after one of his protocols suffered a $52 million hack. The hacker has only returned about $14 million, and Ian's promise to compensate victims still remains TBD. Instead, it appears that the McMahon Brothers are abandoning the Solana ecosystem for Aptos, the new kid on the block, a newly hyped blockchain. Now, when you zoom out, Solana's troubles in recent months seems to have contributed in part to the mass migration of projects and developers to other blockchains. At the time of recording, Solana is still a top 10 coin, but all of this is obviously pretty bearish for Solana. There could be more massive rippling effects as the story continues to play out because the DeFi ecosystems are incredibly interlocked and interdependent with each other. So speaking on bearish events, the US government just made an unprecedented move to sanction crypto mixer Tornado Cash. And this move is seen by a lot in the community as an attack on crypto privacy. On August 8th, the U.S. Department of the Treasury's Office of Foreign Assets Control, or OFAC, sanctioned virtual currency mixer Tornado Cash, which has been used to launder more than $7 billion worth of virtual currency since its creation in 2019. It goes on to talk about its link with the Lazarus Group, a North Korean state-sponsored hacking group that was sanctioned also back in 2019, as well as Tornado Cash's link to the Harmony Bridge heist, which laundered more than $96 million. Now this is major because to some, it actually shows that there is a greater need for anonymizing tools in crypto. And many advocates for crypto privacy believe that this may actually trigger a phenomenon called the Streisand effect, which was named for the actress who attempted to remove images of her multi-million-dollar beachfront property from a small travel blog, but only thrust them in front of the public. Because oftentimes, the things that you try to suppress and ban and prohibit are the things that receive the most attention and in turn have the opposite effects. For many, Tornado Cash is simply a tool that can be used for both good and evil. And privacy is still a right that we are fighting to have, especially in Web3. And I think this may also shake people awake and remind them of why we need privacy tools in crypto. Because if you think about it, a lot of our data doesn't even belong to us. The credit cards that we use, the bank accounts that we own, track all of our spending data and habits, and they sell that information to outside third-party companies who then build profiles about our spending habits, who we are as consumers, and then continue to sell that information to more and more private companies, and we're mostly unable to control any of that data. And I actually think banning Tornado Cash is not only putting privacy crypto in the spotlight, but also going to allow a lot of copycat protocols to pop up in the near future. So this article is an interview with Seth, a Monero contributor who is also an advocate for privacy coins in general, and he actually believes that mixers and anonymizers are necessary for protecting privacy rights of private citizens. And when people ask, and well, why do you need privacy? This reminds me of Edward Snowden's famous quote that arguing you don't care about the right to privacy because you have nothing to hide is no different than saying you don't care about free speech because you have nothing to say. I'm just gonna read out this section of the interview. I'll link the entire article in the description below, but this in particular caught my attention because CoinDesk asks, why do people need privacy? And Seth says, it really boils down to privacy as a fundamental human right. We've never had to battle this hard for personal privacy before the internet, before digital currencies. People just automatically had privacy, and I think we've almost taken it for granted to an extent. You didn't have anyone spying on you because there wasn't the capacity technologically to do so. And the core of who we are as humans and what makes us unique and individual really comes from the ability to have personal privacy and to control our personal private data. And the other big reason is really just to bring control of that data back into our hands so that we can decide who has influence over us. I think that should go without saying that it should be up to the private citizen on how our personal data is handled. Once we realize the need for personal privacy, we can leverage to start to take back control of that data and regain some personal autonomy. Enough of the bearish signals, let's end this video with some bullish signals. Let's start with the CPI numbers that just came out today. CPI, or Consumer Price Index, is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Does that mean it's inflation? Not quite, because inflation is an increase in the overall price level. The official inflation rate, or changes in the cost of living over time, is closely tracked by the CPI. Like other economic measures, it does a pretty good job of this, which is why money markets are sensitive to latest CPI reports. So today it came in at 8.5%, which is lower than expected, causing a bullish relief rally in stocks and cryptos. Feds are finally seeing a cooling off on the overheated markets as we come down slightly, but still down from the 40-year highs of last month's CPI numbers. So when I look at the charts, for example, with Ethereum, you can see that this is a rally from a couple of bullish divergences, but overall, we're still below the 200 EMA lines, which to me says that we're not out of the woods completely yet. And if you really zoom out and look at the macro picture, we've been printing money for so long and had such crazy last couple of years and actually printed so much money that we really need more cooling off time before retail and institutions just pile back in. Now would be a good time to take some minor profits if you had bought the previous local bottom, but overall, I don't think it's the time for retail to be piling in. I think we're still gonna see some pain, but a relief rally is still a relief rally. And that's it for today's video. I hope you found it helpful. Thanks for watching, and I will see you in the next one.